I am dying to ask someone about this trade. It seems like this is the go-to macro hedge. Inflation is a no-brainer. A lot of it is going to be driven by the energy story. But how much of this is a momentum trade, specifically when you look at perhaps open interest in the contracts that have been falling and falling and falling?
Hey, thank you for having me. Look, I think commodities remain one of the best inflation hedges for 60/40 portfolios, and those investors that didn't have commodities in their portfolio actually did suffer a lot more than those that did in the last 6 months. I do think the next 6 months are going to rhyme with the last 6 months, and we continue to see commodities as a great asset to own. And in fact, we continue to be buyers on dips of commodities because we do think that the primary source of the current crisis that we're seeing is essentially a shortfall in global gas and power generation, initially driven by a shortfall in some key inputs in commodities like gas and coal last year, but now obviously exacerbated by the Russian-Ukraine crisis. So we continue to see commodities as the right place to be to protect portfolios against inflation. That's the bottom line.
But how do you square that call with, say, the recession calls that are out there? Because if you hit a recession, or if you're in the camp that we're actually in one right now, isn't the commodity complex the very first trade that gets hit?
It is going to get hit, but remember, back in '08, commodities, and particularly the spike in oil prices to $147 a barrel, was actually the trigger, one of the triggers that took the global economy down. But it wasn't really the main source of the crisis. The main source of the crisis was housing, was leverage in the housing sector, leverage in financial institutions. Right now, we don't have those issues. Right now, what we have is an enormous global gas and power crisis, which is extending into other parts of the energy complex. Think about thermal coal prices reaching $400 per ton in the Asian markets, which is about $100 a barrel. Think about natural gas spiking in Europe again, over $300 a barrel of oil equivalent today. Think about French power up another 10% and more than 50% in the past 2 weeks, over 440 euros per megawatt hour. So we're looking at extraordinary prices for commodities in the next 6 and 12 months. And obviously, this is going to create some challenges in the European economy, some big challenges, I think, in the European economy. But again, the real source of the problem is a lack of supply availability. It is possible that we see prices falling back if the geopolitical tensions, particularly with Russia, start to fade. But I do think that unfortunately, oil at $100 a barrel is not very expensive compared to where other pieces of the global energy complex are trading.
Francisco, let's just talk a little bit about what you've raised there, and that is what is happening with European prices in particular. We can bring up the chart of European electricity. I think we've got the French contract here 1 year out. We've got the German contract 1 year out. French prices in advance of German prices at the moment, but they are both spiking massively. Gas prices, as you say, are extremely elevated. One is connected to the other. At what point do we get significant demand destruction? How much damage is this going to do to the German and French economy over the next 6 to 12 months?
I think it's going to do tremendous damage, and unfortunately, I think some of the policies that have been put in place have probably exacerbated the problem here in terms of the upward trend in commodity prices, and particularly in electricity and gas prices. So I think right now the real challenge is that we don't have the supply to generate the tons of steel, the tons of aluminum, the cars, the washing machines the market wants to produce. And ultimately, because Russian gas cannot be redirected, unlike, for example, Russian crude oil, which has been going to China and India, that shortfall in Russian gas translates directly into a shortfall in European GDP, and it's not something you can recover in other parts of the global economy. So I do think that the collapse in production that we are about to see, we are seeing already in some energy-intensive sectors, and we are about to continue to see in the next 6 months across the broader economy, cannot be made up by production elsewhere. And this is where I think the European economy is moving into a very frail position. And it's one of the reasons why we're seeing also the euro weakening so much in the recent past.
Well, I'm glad you brought up the story of production because that's exactly where I was going to go next. What kind of timeline are you looking for perhaps that ramp up, specifically when it comes to natural gas exports coming out of the United States to the rest of the world? That seems to be a process that's very dependent on infrastructure and the build out in the States, in particular, export terminals, et cetera. To what extent can that still be a longer term solution to this issue?
Kriti, I think it can be part of the solution in the longer term. The problem is over the next 2 or 3 years, all the gas that is going to come out of the U.S. Is already committed, right? I mean, people want this gas, and again, we're in the middle of the summer. This is an obvious statement, but remember, going into winter, we could see extreme competition developing between Asia, between China, Japan, Korea, and various European countries for the few molecules of liquid gas available. And I think, unfortunately, Russia is cognizant of this and is trying to use it as leverage coming into the end of the year. So that's, I think, where I think the politics have gotten mixed up with the economics to deliver, unfortunately, a pretty ugly outcome. So yes, the U.S. could help in the next 5-10 years, but it's not something. U.S. gas is not something that's going to save Europe. Remember, Russian pipeline exports are 2 times more or less what Qatar, which is the world's largest LNG exporter, produces in a single year. And in order to replace Russian gas into Europe fully, you would need to take all the gas that goes into China and Japan in a single year and bring it to Europe. Obviously, that's not going to happen. I'm talking about the LNG that goes into Japan and China, which are the world's number 1 and 2 importers of the liquid gas. So it's very difficult to replace this energy. Unfortunately, it's going to result in lower industrial activity, lower economic activity at this stage. Remember, 1% energy supply is required to create 1% GDP. That's almost as simple as that. It doesn't matter if it's gas or coal or nuclear or wind or solar, but you do need the energy. And right now, we have an enormous shortfall.
Francisco, one final quick question. What kind of a signal is copper providing right now? It seems to be very whippy, very volatile. We've seen the news of China stimulus overnight providing upside momentum back into the metal. But nevertheless, what signal should we be taking away? And what do you think China, in terms of its economic activity, is going to do to change the picture?
Well, I mean, I think China is obviously under a lot of pressure as well because we're heading into a Communist Party Congress, into a 4th quarter, and I'm sure President Xi Jinping wants to show a better economy, wants to also still show strong control over COVID, the COVID disease across the country, but there's been conflicting goals there, and now obviously China is trying to push through more infrastructure spending that's going to support copper. In our view, the main driver of copper prices in the next few years is likely going to be spending on the Chinese electric grid, essentially electrifying the Chinese economy, trying to decarbonize it. So that's going to provide some support in the medium term for sure. However, in the short run, we have cyclical headwinds, as you pointed out. Obviously, copper has been very flimsy because those cyclical headwinds have taken over. And Dr. Copper, at the end of the day, is very much connected to real-time economic activity, and that we know is slowing down. And slowing down for all the reasons I alluded to earlier, particularly the extreme crisis we are having in the gas and power sector globally, ex-North America, right? North America has been a lot more insulated than the rest of the world because of the shale gas production there.